This screencast is focused on January 2016 question 2, particularly around the area of double entry and suspense accounts. So again, it's important that you do have an attempt of this before you go through it, so make sure you read down through the question and ideally make an attempt of it before you watch through the screencast. So here we're asked for 30 marks. Prepare the journal entries for each of the transactions above. So we have 6 separate issues to deal with. So journal entries for each of them, and also then prepare suspense accounts showing the corrections at the year end. So you're talking 30 marks for a 90-minute exam, somewhere around 25 minutes. So that's your gauge when you're doing these questions. Remember, it's closed book. Can you get it out in 20 or 25 minutes about? One thing to note about the interim assessment is if you have a look at the solution, they will already give you templates of where your answers should be. So you'll have to fit your journal entries in here, and your T account will have to be fit in part B. So typically it's already prepared for you in an answer booklet. So just be careful of that and don't be surprised in the day of the exam if you see those layouts. So this question says we started off with a debit balance in the suspense account. So there's an opening debit balance of 569,384 and there's a number of issues, 6 of them to be identified. Now in reality, if a question like this comes up, you're probably going to do them simultaneously. That you'll have the T account opened as you'll have start the question, and once you update each of the journals, you'll slot it into the suspense account if relevant. So here we're just going to slot in per TB debit balance of 569,384. So that's just our starting point as to that's what the opening balance is, and we're trying to explain then how can we remove that based on the 6 issues we've identified. So we'll just go here to journal 1, and we're going to deal with the software problem. So what happened here was the software problem purchase on credit of 4864 had been included in trade receivables. So again, if in doubt, always do a 3-step approach. What should have happened compared to what did happen, and then what that will result in is your adjustments. Now for sometimes you won't need this, but for other times when it's a bit more complicated, you need to think through exactly what you need to do. So I'll do this for some of the more complicated ones to help you along. So in this case, what should have happened? Purchases on credit should have been debit purchases, credit, trade payables. 4684, 4684, should be 4864. So that's what should have happened, and that's okay. What actually happened was, and this is, some students got caught with this, they debited purchases 4864, but they included in trade receivables, meaning they debited trade receivables 4864 as well. So clearly that wasn't going to balance, so they must have credited the suspense account the balancing figure, so twice that amount, 9728. So we can see that was a tricky element. You had to assume there that it was included in the debit side of trade receivables. You could have assumed otherwise, and that would have been valid as well. But for now, we're assuming that that's what the entry they've made. So the adjustment then is to debit suspense 9728 to clear it out. We're going to credit trade receivables because it should never have been there, 4864, and we're going to credit trade payables because that's where it should have been, but it wasn't. 4864. So you can see the benefit of taking that 3-step approach, that if you compare what should have happened to what did happen, the adjustments should hopefully fall out. And that's our adjustments here. And of course what we're interested in is there's journal 1, 9728 on the debit side. So that's slowly helping us explain the balance of the suspense account. So that was our journal 1, taking the 3-step approach. And again, in the answer booklet, what they're looking for is this answer here. You may be able to show your workings in the back of the answer booklet, but when you're doing the template, you're putting in your final answer. So journal 2 then, we're told here on the 1st December, just before the year end, they received a loan amount to 240,000 related to possible purchase of a building. So they haven't actually purchased it yet. And interest accrues on the loan at a rate of 5% per month. Half percent per month, should I say. So there's no repayment then until June 2016. So Laukly has made the following entries. So they've debited PPE and they've credited trade payables. So straight away we know actually that's not right because you didn't buy the building yet and you actually took out a loan. You didn't take out trade payables. So you can do the 3-step approach as you'll see in the solution. But the easiest thing to do here is reverse that entry, credit PP 240,000 and debit trade payables 240, because we know straight away that's incorrect. We didn't actually use the money prior to year end, therefore it couldn't have been in PP. So if we're starting from scratch, then we would have debited cash or bank, let's say bank 240, and you will credit loan because it's a loan account of 240 as well. Right, so that's the first adjustment. So to debit bank, credit loan. And the other thing to make sure you ask yourself, well, why am I told about the interest? You're going to have to recognize finance costs for the month. So it's going to be 240,000 times 0.005, 0.5%. And you're going to credit accrued finance costs, 1,200. Because remember, you're told there's no repayment till June 16, so it wouldn't have been paid at year end. And notice there has been 2 entries here, so there's no such thing as a balancing figure. So this will not impact the suspense account. It is incorrect, whereas it did up here because there was an imbalance on the debit side. There's no imbalance here, so therefore there's no impact on the suspense account. But still, for part A, you have to put in these core adjustments to get your marks. So that's your journal 2. Journal 3 then, if we read down through it. A dividend of 26,000 was paid in relation to the year end, was declared in January and paid in January. Right. The following entry made in the financial statements: debit retained earnings, credit bank. So again, we know, hopefully, the relevant standard for whether a dividend should be recognized or not is IAS 10. So what actually should have happened here is, if it's declared after the year end, it should not be accounted for prior to year end. It can only be declared, if it's declared before the year end, that's fine, but it's after the year end here. Therefore, IAS 10 says you should not recognize. So what should have happened here is nothing. There shouldn't have been any adjustment based on IAS 10 guidance. And remember, IAS 10 is one of the examinable standards for the interim assessment. So what we need to do now is we need to reverse that. We need to credit retained earnings and we need to debit bank. That's 26,000, 26,000. And again, it does balance already. There's no impact in the suspense account, so therefore it doesn't impact the T account. All you're worried about there is that IAS 10, and I put down IAS 10 as well to show the examiner, you know, if it's declared after the year end, which was after the 31st December 2015, you do not recognize it. Therefore, you have to reverse the current entry. So the next one then is Journal 4. So just keeping it nice and neat as we go down along. And this is, again, see how the examiner brings in a couple of areas into the question. Here we have consolidation. So we have, at the year end, Laukly purchased a 90% stake in Rango for 600,000. So again, we're assuming there that's going to be controlled. So you're going to have consolidation of a subsidiary. You're given the fair value in the assets and liabilities and the net assets, which is 580. And you're told how they've accounted for the transaction. Debited suspense, credit share capital, credit retained earnings. And NCI is measured using method 1. And there's no fair value adjustment because the fair value net assets are equivalent to their book values. So firstly we see, well, this is the accounting they've done. They've debited suspense and they've credited share capital and retained earnings. And of course we know that's not correct. What you should be doing is, if you acquire a subsidiary, you bring in all the assets, you bring in any liabilities, which there are none here, and you recognize the NCI, because there'll be 10% of the assets you don't own, and any goodwill. So you have to calculate whether it's goodwill. So I think the easiest thing to do first is, you know that entry is incorrect. So the easiest thing is to probably start from scratch. You will credit suspense, 580. You will debit share capital, because crediting is increasing share capital, which is wrong. And you will debit retained earnings, because that's not the right adjustment either. So this is testing your knowledge of IFRS 3. So here we're going to debit share capital 500 and we're going to debit retained earnings 80. So you can do it a number of different ways, and the solution shows you the longer 3-step approach. But the easiest thing is reverse the prior entries and start from scratch. So now if we were going to start from scratch, what will we do? Well, we'll say we should bring in all the assets, debit property, plant and equipment, 580. Say bring in all Rango's assets. There's no liabilities, that's fine. We need to bring in an NCI. We need to credit bank, because remember we actually paid for this 600,000. So your 90% share cost you 600,000. And once you calculate the NCI, you're going to figure out whether you have goodwill or negative goodwill, which is a gain from bargain purchase. So what we're going to look at here then is a simple calculation. Let's calculate whether there's goodwill or not. So how you calculate goodwill is you pay the consideration plus the NCI minus the fair value of net assets. So that's the simple calculation here, is whether you have goodwill or not. The consideration you paid was 600,000, and that was for 90%. The NCI, we don't know how much it's worth, but you're told it's proportionate share of their fair value net assets. So net assets in this case, because the acquisition date was the year end, was 580. So we don't need to concern ourselves about post-acquisition, because it just so happened the acquisition date was the reporting period date, just to make things straightforward. So that means the NCI is going to be 58,000, 10% of the fair value net assets. So then the goodwill is the difference between the consideration plus the NCI minus the fair value net assets is your goodwill. You paid more than what it's worth, to the tune of 78,000. So you will recognize that as an asset, and you will recognize this is the credit balance in your equity section. So you'll credit NCI 78,000 and you'll debit goodwill. So that'll be 58, apologies, and this will be 78. So on this side you have a total of 658 and you have credits of 658. So it's always useful if you get them kind of consolidation questions, do a little calculation yourself first. And then you'll know, right, here are all the entries I have to make. Decide then whether it's debit or credit. I'm crediting bank for the consideration. I'm crediting NCI for its balance. I'm debiting the assets, 580 that I'm bringing in, and I'm debiting goodwill, 78. That's how the thing balances up. And you will notice there's one issue in terms of suspense. We need to credit the suspense account 580 because we need to remove that debit that was incorrectly done. So here, if I go up, Journal 4, you have J4 580,000. So that's going to make a good dent in explaining or tidying up the suspense account. So you can see again how this examiner can layer it in. You had an IAS 10 issue, you had normal small DEBK, CAP1 style ones, and you had a consolidation IFRS 3. So there's a good variety in these types of questions. So make sure you do cover all the accounts or standards that are examinable. We're told here an invoice related to audit fees for 7.5 grand needs to be accounted for. So this is what you'd call an accrual. It hasn't been accounted for yet. Therefore, there's no imbalance that will result in a suspense account. So therefore, there's going to be no entry in suspense account, and all you have to do is, what actually happened was nothing. You should debit audit fees, 7.5 in the P&L, and you'll credit accrued fees, 7.5 as well. So that's in the current liabilities. So what you're looking at there is you're debiting the audit fees 7.5, you're crediting accrued fees, that should be ACC, which is a current liability 7.5, and no impact on the suspense account because again there was nothing entered originally, so therefore it's complete omission. So it wouldn't have been an imbalance in the trial balance. And finally then, for 6, your discount received 462 has been debited to the discount allowed account. So again, we'll finish off, we'll do what we had before, what should have happened, just so you can understand what did happen, and again, let the adjustments fall out. So when in doubt about what to do, always do that 3-step approach. So what should have happened for discount received? Well, in that case, you should have debited trade payables and credited discount received. That's how you account for a discount. You reduce your supplier, person you owe money to, because they gave you a discount, and you recognize an income in the P&L of 462. Now what they've actually done here is they've used the wrong amount, number one, transposition error. They've mixed up the figures, and they've also used the wrong side. They've debited the discount allowed account. So what they've actually done here is they've debited trade payables, you assume is fine, 462, you're assuming that's okay. They have debited discount allowed, 426, and they have credited the suspense account to balance it up, the tot of these. Now, there are a couple of different assumptions you could have made there, and that would have been fine in the exam. The examiner wasn't really clear whether, well, did they use the 462 in trade payables, or was it the 426 as well? So there are a number of different assumptions. Don't be too put out there if you assume this is what you think happened, because it's not 100% clear what exactly happened to each account, and you account for that correctly, then you'll be more than fine with the credit you'll get. So this is the assumption we've taken the solution, so we'll work with this. So here then, the debit, the trade payables are fine in both. You should have credited discount received, but you didn't, so we're going to adjust that, and credit discount received will be one adjustment, 462. That should have been one adjustment. You shouldn't have debited discount allowed, so you're going to credit discount allowed, 426, because that shouldn't have happened, so you need to remove it. And finally then, the suspense account shouldn't have happened, so you're going to debit suspense, 888. So what you'll see there then on the debit and the credit side both come to 888. So based on those then, we have the final entry into the suspense account. And again, the nice thing about these are you should know journal 6 if the thing is correct or not. So on this side, if I tot them up, I have 580,000, and likewise here. So both of my sides of my suspense account tot to 580,000, that tells me I'm correct, because you want to clear out the suspense account at the end of the question. So again, that was January 16 question 2, the interim assessment. A good idea how DBK knowledge from CAP1 about suspense accounts and smaller errors, as well as more CAP2 style IFRS 3, IAS 10 issues can all be combined together. And remember, just to judge your own timing in that question, 30 marks, you're talking in and around 25 minutes.